as we head into the New Year period. Hopefully everyone gets a bit of a nice break over Christmas. As Brent mentioned, so yes, I'm Bryce Leyden. I'm a client sales executive out of Vanguard. With the presentation today, I'll give you a quick background on who we are here at Vanguard, and then I'll jump into an update on what we've seen as a result of the US election and what sort of impact that's had on the markets, and then also how we're seeing Brexit evolve as we start to get closer to that year-end deadline. So we sort of skimmed on those in some of the last presentations, but I'll delve into those a little bit further today. And then I'll run through what we've seen occur in the markets over the last 6 to 12 months. And again, just a quick update on how we're seeing COVID play out, as that's sort of still a key driver in the markets. And then we'll have a look at the global outlook and what our returns forecast is looking like for the next 10 years. And as Brent said, happy to take questions throughout. So just either unmute yourself or just chuck them in the chat. Before we do get stuck into it though, I do just need to remind everyone this is all general in nature that I'll talk to today. So it won't be anything personal to your own circumstances. But as always, lucky for you guys, you've got a few financial planners on the line. So feel free to reach out to them if you do have any questions about your own personal circumstances. So I said just quickly on who I represent. So I work for a company called Vanguard. We've been around in the funds management industry for over 40 years now, starting in 1975 out of Malvern, Pennsylvania. We actually opened our second office here in Melbourne, Victoria. So we've had a presence in Australia for over 20 years as well. We're one of the world's largest wealth managers, managing over $9 trillion now. One of the key features of us is our mutual fund structure. So like a not-for-profit or an industry fund, we're actually owned by our members. So as we grow in scale and size, we'll actually return those profits back to our members through lower fees and lower management expense ratios. So that's sort of something a bit more unique about us compared to our competitors. So as I said, I'd touch on the US election, and a lot of you have probably been wondering.
Yeah, I reckon I'm cracking that because my booster upstairs has been working fine. Other than that, tonight I might jump on and I'll have a look at what you're
See if we can mute that.
both feeds are like in C, because it could be the EPQ's playing up, and then we can do a test on
Perfect, thank you. So a lot of you have probably been wondering with the US election what that means for us here in Australia. Obviously, we're fairly separated, but it's very easy to get caught up in all the noise of it. And we'll have a look at maybe how this has been impacting holdings. So as we know, the votes have been cast and Biden has been declared victorious. Although whether Donald Trump will really accept that anytime soon, I think he'll probably go down saying that it was a rigged election. But unfortunately, that's something I can't really answer at this stage. But what I'll run through is, I guess, the impact we've seen the elections have on the short and long term of investments. And then I'll also explore what the short and long run impacts look like at the moment as we draw closer to the end of the trade deal deadline for Brexit. So just seeing what that looks like in the markets. So what we decided to do in trying to understand how an election can have an impact on the markets, we decided to analyse how investments have performed each year. So we looked at a 60-40 US investment portfolio, held 60% in stocks and 40% in bonds, and looked at the annual performance dating all the way back to 160 years ago. So giving us a really large sample size to deal with there. We separated the years out into ones where an election took place, and then the other three being deemed non-election years being grouped together. And what we found when running the average return for each year was that whether or not an election took place within a year actually had no significant or statistical significant impact on the performance for that year. If anything, the performance was actually slightly higher in the 40 years where an election took place historically. So what we found was a lot more of the performance in these years was being determined by market factors that were outside of the election results. Although this year will be a bit of an outlier if you look at the average, but that's a lot of that's coming down to this sort of COVID impact we're seeing through the markets as opposed to what the election results have really been. I guess as well, given the horse race nature of political campaigns, you may think that, well, okay, well, if it doesn't affect it on an annual basis, what about the months closest to an election? We just see a lot of media and a lot of tension around this. Is that creating some volatility in markets? And what we really found as well by doing analysis was the opposite has been true for the days leading up to and after an election. So we studied the S&P 500, which is the top 500 companies in the US. and looked at the volatility of this market over a 55-year period. So again, a large sample size. And what we found was that the average volatility around elections was actually lower than the general average over that entire 55-year period. So on average, the volatility in the 100 days before and 100 days after was actually the same. So it didn't matter which side of the election you were looking. And that was actually lower by nearly 2% in the full period average. So in those days before and after, it was about 13.8 compared to 15.7. So in looking at it though, it's not that we're not saying elections and events surrounding them aren't important or don't create uncertainty. I mean, look at this year's election, so much media attention around it, especially if you involve someone like Trump and what's going on in the US at the moment. You tie this in with the effects of global health and economic crisis, and it can really feel like a really uncertain time and quite difficult to understand what you need to be doing. And this again ties back to we see these periods as that key point in your investment cycle to remain disciplined and not let that uncertainty take over your decision making. So we've seen in previous economic events and even earlier this year, we've seen that being able to stay disciplined and sticking to your plan is going to keep you in that best long-term path to reach your goals. And what we're seeing has been that the key determinants of performance in the current market are still going to be these global health and economic crises, which I'll provide a bit more of an update on later after we get through Brexit. So as I mentioned, we're drawing closer to that deadline for defining the terms of a post-Brexit trade relationship between the UK and the European Union. And there's not a lot of clarity here on what that would look like. And I guess the only thing we really take away from it is we're very unlikely now to see a comprehensive deal be struck between the two parties. It's very likely to either be a bare bones deal or a no trade deal. Realistically, a no trade deal would see the UK result back to World Trade Organization rulings, which would actually hinder a lot of the trade between those countries. But what we're seeing is that whether it's a bare bones trade deal or a no trade deal isn't actually going to have a massive impact on the long-term effective markets. As interestingly enough, a lot of the initial impact was actually priced into the markets when the UK decided to actually create that separation. So we saw a lot of volatility and a lot of drawback when that Brexit first was announced. It's not going to rule out that short-term volatility. I'm sure we'll see as they sort of jostle for what that deal looks like, or if they don't go down a deal. But again, it sort of touches on, unless you're investing for a short term, you really just need to kind of, I guess, drown out the noise and just remain focused on that long-term impact. And what we've charted here is what that long-run impact looks like between the two options. And as you can see, that impact on GDP is only around about 1.5% between a decision to go with a no trade deal over a bare bones deal. And we've even been able to split that up into what will make up that drawback. And essentially, it's the combination of a labour supply impact due to people being unable to freely work between the EU and the UK, and then also the productivity loss, as it's going to be more difficult to move goods and services over borders, and it's going to become much more costly. When we're looking at this around a negative 6.4% or a negative 7.8%, that's not our 10-year forecast for the GDP of the UK. Essentially, what we're looking at here is which way they go on Brexit, we're seeing it's going to be a drag on the GDP of the UK. So we're still expecting positive growth here, but we're just seeing that this is going to have a negative impact over a 10-year period on them. So essentially, though, tying back into it, COVID is still going to be the biggest focus here when we're looking at the UK. If you've been following the news at all, you've probably seen that they're once again wrestling with those COVID numbers and have started sort of implementing restrictive measures, and they'll probably look to go into a full lockdown soon, which is going to be a bigger impact to their economy than what the Brexit deal looks like. Okay, so as I presented on in the past, coronavirus, and as I mentioned, is still the leading factor that's having an impact throughout the markets globally. And we've seen this more recently with markets reacting very strongly to news around this. So over the last week or two, we've experienced very large market movements as a result of that positive vaccine news that came out around its being very strong in its efficiency. We're expecting to continue to see a lot of volatility in the short term as we're seeing markets try to really understand what that vaccine means for the future of COVID and how long it really realistically is going to take for that vaccine to be made available, how quick is it going to then take effect, and when will we see sort of this COVID sort of be in the back mirror? What I'll also touch on in my next sort of couple of slides is how we're seeing COVID's potentially changing the way businesses operate completely going forward. So as we start to move probably more into a digital world. So what does that world look like post-COVID?
Just quickly,
yeah.
I don't know if you touch on this after, but like I've read a little bit about the vaccine and those sorts of things. Like there's, I know comments made, and obviously with the fact they've come up with this vaccine means that humans can sort of develop these things. But one of the thing about the Pfizer vaccine was the -70 temperature, needing to sort of keep it at that level, and how to transport that and all that sort of thing. Like, does Vanguard have a view on that?
We don't necessarily have a view on, I guess, that around the temperature and what that means. Essentially, what we've done when we looked at this is we're actually probably on track for when we thought the vaccines were going to be available. But the biggest thing for us at the moment is just how effective they've come out being. So I think initially, even in the US, they were saying they were hoping for around 50 or 60% is actually a pretty good result. Whereas coming out with sort of 90, 95 means it's actually going to have its impact a lot faster, and they can actually look to give it to more larger groups of people and sort of start to get that herd immunity going a lot faster. Whereas if it was around that 50 or 60, you'd be very selective around who's getting it. Obviously, it'd probably be more dangerous for elderly people receiving it, whereas with that very positive screen they've got. But around I guess that's going to be the next question, is how much, I guess, stock can they get out? So I know Australia's aligned with Pfizer, but essentially when can we get the stock in, and when can that start to be really rolled out to people? And as well, I'm probably happy to get a vaccine, but whether or not everyone's happy to roll out and get this initial vaccine is probably the next thing we'll start to look at, and probably they'll start to get people's opinions on, are people actually going to go out and get this vaccine straight away, because that's going to be the next step. Perfect. So what we have seen in the markets over the last few months is risk, sort of the market's been bouncing between risk on and risk off as they start to look at investor sentiment around policy announcements, economic data, changing COVID-19 cases, the vaccine. So the markets have been bouncing very rapidly around any news on that front. As we can see on this graphic here on the left, the performance across regions or countries has not been equal. And we've touched on this previously, but just again wanted to highlight. So if you look at a country like China, which is, I'll use my little laser pointer here, which is this lime green line here at the top. So again, being one of the strongest performing countries this year. And a lot of that has owed to that first in, first out experience that they've had with the pandemic. So obviously being the origin of the virus, but then being able to stamp that out very quickly. They've seen supply return very quickly and production return very quickly to their economy. But we've seen that now start to lag as they're kind of waiting for the rest of the world to catch up to that demand to return. So although they did see that very quick recovery, it's sort of mellowed out now over the last quarter or so. The next one I'll look at is the US. So the US has dwarfed a lot of the rest of the developed markets around the world, even with that extreme number of cases that we're seeing, and they're still trying to lock down. And this is largely owed to the tech-heavy indices that make up their economy, and also their sort of focus on healthcare and pharmaceuticals has sort of allowed them to sort of avoid a larger fall than probably the rest of the world, given the case numbers they're seeing. Australia, which you may have already looked ahead, but is this orange dotted line, unfortunately, towards the bottom of the markets. And as you may know, we've lagged quite heavily, and a lot of this has come due to that renewed surge of COVID cases that I've personally experienced here in Victoria. So because of how we're having to put on those large lockdowns, we've seen a sort of drawback or a slowdown in our recovery. And that is because Victoria actually accounts for around about a quarter of the national GDP. So unfortunately, that strict lockdown has created that sort of drag on that recovery. And then what I've got on the right here is just the difference in experience we've seen between industries. So probably unsurprising that, yeah, some industries have managed to fare better through all these lockdown experiences and all this impact we've seen. And that has also tied into the performance we've seen in countries. So as I mentioned, the US with their very heavy technology-driven and healthcare-driven indices has performed quite nicely. Whereas if you think about what drives a lot of the Australian market being in around that energy, professional services, financial space, you're seeing here that was unfortunately one of the worst hit industries, with a lot of that owing to that face-to-face nature and unfortunately putting a bit of a drag on those industries. As I touched on though, COVID is pushing us towards probably what this new future looks like when it comes to work. So it's probably no surprise to anyone on the call that we've kind of been going down that path anyway. If you even think about what we're doing right now, it wouldn't have been long ago before that wasn't really an option. I would have had to have flown up and come in to deliver a face-to-face presentation. And this is sort of where this new term, sort of new ways of working, is coined out of. So it's definitely floating around our office a lot. I'm sure it probably, for some of you, it might be floating around yours as well, and around the globe, it definitely is. So it's not a new concept. It's been around for quite some time and growing in the industry. When you think of your Ubers, your Amazons, your food delivery services, we've been going down that path for a long time now, where we're actually reducing the amount of face-to-face interaction you need to use anymore. But what we've just seen as a result of coronavirus is that's very much sped up the need for implementing these in offices. So insight into my own world, I mean, I've been working from home since middle of March or early March now. So I mean, that's definitely a new way of working that probably wouldn't have been an option quite some time ago. But on the flip side though, there are still a lot of industries that won't be able to move towards that new digital way of working. So think about places that do still need a physical presence and need a face-to-face service. So some of the key ones highlighted here are sort of your restaurant workers and bartenders. I think everyone going out for a nice meal probably still wants to be served by a waiter and have that personal touch. And also think of sort of like a meat packer or a lot of industrial industries where it is all hands-on labor. So again, you're not going to see that changing anytime soon. But these unfortunately are the industries which have been hardest hit by COVID and that drawback, as it's just impacted their ability to actually get to work and actually create production. So hopefully that positive news around a vaccine, hopefully being available early next year or later this year, will start to allow us to reopen those industries more openly and get them back going. And as I mentioned, sort of those lockdowns will stall recoveries through industries. So what we've shown here is the experience we've had here in Australia. And what we do here is we actually chart the high frequency indicators between industries. So what that's really looking at is the amount of traffic through these industries here. And what we're showing is these grey bars are the bottom of COVID. So when all of Australia's in lockdown, so unsurprising, every restaurant's closed, so 100% decline. And then what we've shown is where we were at the end of June. So this was sort of when everything was nicely reopening around Australia. But then unfortunately, these red dots are where we were at the end of August. So that's encompassing Victoria's lockdown again. So it just shows how going into a subsequent lockdown can sort of pull you back and just slow down that recovery. So it hasn't pushed us all the way back to those those original COVID levels, but it is just taking a bit of a slowdown. And as well, you can see on spending intentions, it's having a bit of an impact through there. The extension we saw of fiscal support until March next year will have had positive impacts on trying to reduce the likelihood of permanent job and business losses throughout Australia and especially in Victoria. And that is really important. I'll throw to now. This is US focused, but it is showing, I guess, the negative impact of having your economy sit in hibernation for prolonged periods of time. So as we can see over the last quarter, we've seen a lot of these employees who were on temporary leave have been permanently made redundant. As you can see, by the end of September, that was around 30% of those employees. So not numbers you really want to be seeing. And this is where the importance of government fiscal support is really here in Australia. So the ability of keeping businesses, for lack of a better term, above water until those face-to-face and demand can resume is really important for ensuring a strong recovery out the other side. And essentially what we've learned from past crises in the past is that having a high proportion of permanent unemployment can actually have significant impact on the shape and strength of the economic recovery. So given unemployment will actually have a spillover effect on consumer confidence and spending. As you probably suspect, if you've lost your job or you're concerned about the future of your job, you're not going to go out and spend with confidence or buy sort of those luxury goods or go out and spend more than just the bare essentials. So essentially that's what the government wants to try and avoid, is just to make sure that everyone can keep employed and keep spending and return to a normal as fast as possible. With sort of what the impacts we've seen, we are expecting that to take a lot longer in some of those face-to-face industries to recover. We're hoping we can avoid some permanent scarring effects as of COVID. In order to see a full recovery in the economy, we will need to see governments start to shift their focus from fiscal support, from providing sort of relief payments such as the JobKeeper and JobSeeker, and start to move more towards stimulus payments, so promoting business spending and expansion. And we've already started to see a small shift in that here in Australia. As you can see, when COVID hit, there was massive amounts of government spending on keeping Australians employed and receiving cash flow. So, I mean, look at these numbers here. So policy cost here around 80 billion. So a lot of money going into keeping people employed or at least receiving a form of income. And now as we start to see some confidence in the COVID numbers and that businesses will be able to reopen, the government really wants to focus in on getting them to go out and spend money on capital expenditure and expand their businesses to be able to take on employees once again. So what we've shown here on the right-hand side is the spending intentions of sort of the key industries here in Australia. So manufacturing, mining, and then the rest of Australian businesses. And what you can see is as of December, so pre-COVID, those spending intentions were very good, sort of 10+% a year on year spending. And then as COVID hit, sort of as you can see, sort of that uncertainty starts to roll out, the spending starts to reduce, but there is still some spending going on. And as we've got further into year, as of June, they really start to roll back as they start to feel what impact that might have on their business over the years. So they start to think we can't be growing in an environment like this. But that's where the government wants to try and shift that focus and provide support to businesses for them to go out and start to spend again, because that stimulates the economy and gives us that best chance of a rapid recovery early next year as we come out of this. To now put that sort of maybe into more market context of maybe what you may have experienced in your own portfolios or what you're seeing happen when you listen to the news or if you look at the ASX. So what we've charted here is as of 1st of January to year to date, or as 12th of November, is just what that experience looked like for the Australian Shares Fund, an international or global fund, and then a variety of our diversified funds, which are a mixed blend of international and local equities, along with international and local bonds. So with that growth and defensive portfolio. I think I'll highlight here just the experience of an Australian investor. And this again is where we sort of promote that staying to your guns and just sort of sticking through some of these troubled times. So I mean, at the very bottom of the market, I mean, your holding from the start of the year would have been off about 30% if you just held an Australian portfolio. As you can see over the subsequent 6 or 7 months, as we've seen this recovery, this sort of investor would only sort of be out of the market under $500, which is pretty impressive to think of where we were only 7 months ago. So someone who decided to make a drastic move during that period may not have had a very pleasant experience if they got out at the wrong time. So that's where we sort of say, in the short term, you will experience a lot of volatility, but just sticking to that long-term plan can put you in a good position. And then some of these other charts around our diversified funds here. So just show the benefit of having a blended portfolio, a diverse holding of growth and defensive assets. It's just giving you a much smoother ride over this period. So less of a drawdown in the market drop, but then also sort of a smoother ride up the other side. So that's just, I guess, put in a bit of context around what you're probably seeing in your own portfolio. And so what we've been doing, talking is mainly sort of backwards looking. And what we'll look at now is that forward outlook. And what we want to look at here is around where we're seeing markets valuations at the moment. Are we seeing them sort of fairly valued, overvalued, or undervalued? And that sort of ties into how we do our forecasting on our long-term forecasting over a 10-year period. So when we look at equity, sorry, move that screen. When we look at equity valuations, we look at the price to earnings ratio. And essentially it's a valuation metric that looks at a stock's price relative to the company's earnings per share. And what we look at over a long period of time is what that historical average has been. And also sort of within a certain range, do we see them still sitting at a fair value? Or do we think if, as you can see, sort of up around here, sort of pre-GFC, we probably saw that markets were overvalued. And then usually off the back of a recession type event, we tend to see that markets become undervalued, which sort of makes sense when you think about the way that the equity markets would have performed. But what we've seen is we have seen equities continue to rise in the third quarter, albeit at a moderate pace. And we've started to see some investors start to question whether or not the attractiveness is still here in those equities, or whether we're starting to see that become overvalued. Especially since we've seen Australian equity valuations rise by about 20% recently over the last year. We personally still maintain the view that Australian equities appear to be fairly valued. And a lot of this does owe to that significant correction, which you saw on my last chart back in March, where we saw a large correction in the valuations of Australian equities as well as international, which we're still seeing markets recover from. What we have seen though is probably in those overseas stocks, especially in the US and China, which I touched on earlier, which have been able to rally a lot faster than the rest of the world. We have seen that their valuations are a little bit higher than what they are here in Australia, but we still see them as fairly valued and still a lot of potential here. In contrast, we've seen the UK and EU quite struggle to regain any ground amidst sort of a lot of that uncertainty and trajectory of the virus, again, tying into a lot of those factors I spoke to earlier. Although our outlook going forward does remain quite optimistic and isn't largely changed from our mid-year forecast, which I presented last time, but I will just sort of show you where we're sitting at the moment. So as I said, some of you may remember this from my last presentation, but when it does come to forecasting returns in the market, our economists do like to take a long-term approach and look at what the likely outcomes will be over a 10-year period. As I mentioned, trying to pick volatility in the short term is very difficult, so we do take a long-term outlook when it comes to these. We generate these return outlooks by running over 10,000 simulated market outcomes, given a variety of conditions, so where we're seeing sort of the pandemic go, where we're seeing Brexit, all these sort of factors we tie in and create optimistic and pessimistic as well as central expectations. So this blue bar is where we do like to focus our attention, as this is the most likely outcome when it comes to these asset classes. This in the green is our optimistic view, which is sort of that upside potential, and the purple is the downside, or the, I guess, worst case scenario. Just because we see an optimistic view or optimistic outcome in, say, Australian equities, it doesn't mean that we see optimistic outcomes for global equities, Australian inflation, all that. They do operate separately of one another. But as I mentioned, our expectations for equities do still remain quite optimistic and have actually improved quite significantly from pre-coronavirus levels, or I guess December last year. So our central expectation at the moment for Australian and international equities is around about that 6.5%, with sort of some potential upside around that. And we're expecting interest rates, though, on the other side to still remain quite low, as we're seeing at the moment with the RBA cutting rates once again. We're expecting returns of fixed income and cash to remain around about 0.5% to 1.5%. We're not expecting them to raise that anytime soon, or at least in a drastic measure. So we're still seeing that probably quite muted. However, we still see them playing a very important role in your portfolios, as we saw probably earlier this year even. So not one to be discounted out of your portfolio. Just to wrap up some of the key takeaways, we're seeing, again, in the US election, it's quite an important event globally, but probably not nearly as important as you may think for the long-term performance of your portfolio. And the same can be probably said about Brexit. So they're both going to create some volatility in the short term, create a little bit of noise in the market. However, most of that impact's been priced in already, and we're not seeing that going to be a huge detractor over the long term for those markets. As I mentioned, around the recoveries we're seeing through industries and through global markets, we're expecting to see that probably happen at very different paces, although we are starting to see that recovery, which is good. And we're hoping to see governments start to shift their attention around supporting that recovery as opposed to going into a bit of a defensive mode. And then around global assets, as I mentioned, we're quite positive in this space with recent market performances earlier this year, actually upgrading our expectations for market portfolios over the long term. So we've actually improved those by around about 1.5% from what our levels were at the start of the year. I'll leave it there. I will just see if there's any questions in the room, or if you've got any that you want to throw out, Brent.
Thanks, Bryce. That's been great. Yeah, I might open to the floor to see if there's any questions. So if you just want to unmute yourself or pop a question in the chat box, we can ask Bryce. But I think, yeah, you've done a great job there and given us an overview there. Thanks.
Perfect. Thanks. Yeah, unfortunately, yeah, I kind of hope by now I wouldn't be focusing too much on COVID, but I think we've probably got at least another 6 months of heavy COVID news ahead of us.
Well, in absence of questions, I did have a couple here prepared, Bryce. So I suppose a question I think is on everyone's lips is the interest rates being so low. As you said there, like before, the defensive part of the portfolio plays an important role. It helps as a ballast if there's a fall in equity markets. It's there to sort of prop things up. Like, do you see that as a catalyst to maybe pushing the markets higher, and even to the extent where they might become overvalued again, purely just because people are chasing that income?
I think so, and it's sort of when we look at these at the moment. Chat's on screen. We still see, as you say, we still see the bonds playing a key role, and with that low interest rate, that's probably there a lot to try and just prop up the economy as we're seeing it quite in a difficult time. I think as we start to see things settle down, we probably start to see that interest rate rise once again. But I guess the hazard at the moment is you don't want to, I guess, chase yield too hard at the moment, as you can sort of probably unfairly skew your portfolio to be a little bit riskier than you want to be. And I guess the risk is there if we do sort of see any left field events or anything like that, you can find that your portfolio is not in the balance you want. So then you're not holding those bonds to hold you steady during another potential short-term dip or anything like that we might see in the market. So I guess we just want to make sure that people aren't trying to chase too much value at the moment and give up on, I guess, the principles they've started building their portfolios on.
Yep. So just, I think, yeah, for those, I noticed there's a few names here that have been on a few of these webinars. We probably sound like broken records here, but as Bryce sort of said before, you need to sort of stick to that long-term plan, remain disciplined, and I know for clients that are adding money into the market, it's sort of about dollar cost averaging, because again, I know something like those vaccine announcements, I think the market's been pretty optimistic or
yes,
like those announcements. If anything to the contrary of that, or the later stage trials don't go ahead and anything comes off the back of that, you can see some pretty sharp corrections.
Yeah, definitely. Yeah, any news, and as I mentioned, any news around that's going to really push the market, as everyone's trying to price in that long-term impact of what it means. So we're not talking about very short-term when it comes to the vaccine. I mean, it could really drastically dictate where we see ourselves in 6 months' time versus 2 years' time. And we actually have probably, if you've been to any of our past presentations, I think I showed some optimistic outcomes for the economy and some pessimistic of what might happen around the vaccine news. And we're actually fortunately sitting in that optimistic view at the moment with the vaccine. So as I mentioned, we're on track for the same time, but with that actually really efficient use of around 95%, we're actually sitting in that optimistic outcome for recoveries in economies.
Yeah, I just personally still can't wrap my head around. Obviously, the virus and the vaccine is great, but when you look at some of the numbers coming out of the US of daily numbers,
yes,
I know 10 or 20 in South Australia, I think like they've cracked over 160,000 cases in a day, which is just mind-boggling, really.
Exactly, and that's where the market, I think that's probably where we saw that drawback from that initial real heavy optimism from the vaccine last week was, I think it sort of came back in that reality that the US is in a very high case number spot at the moment. So the vaccine is not going to turn that overnight. I mean, we're talking about months and months. So I think that's something that realization that there is chances there. And I think even the US have spoken around rolling lockdowns in certain locations and states. So, I mean, that's where I think the market is now trying to think, okay, what impact's that going to have? So that's where we'll see that short-term volatility as everyone's trying to just understand what that means.
Any questions, anyone? Last opportunity. I haven't had any in the chat box, so I think you've given a good overview. Thanks, Bryce.
Perfect.
Done a good job as always, Bryce, so thank you.
No worries, thank you. I'll hand back to you guys. I'll stop sharing my screen.
I guess it's the who would have thought this COVID just, as you said, it's like we thought it would probably, it's going to still keep going on for a period of time, isn't it, really? So yeah,
It's fortunately, I mean, hopefully Adelaide can just sort of lock those numbers down, and then we can kind of just open up Australia. I mean, that's kind of the hopeful at the moment, especially ahead of the Christmas period. It means we can all kind of travel around and enjoy ourselves a little bit more and not worry too much. I think that's kind of be the reality. I think I even saw they've locked down flights to the US and UK for the next 12 months or 9 months anyway. So I don't think we'll be heading overseas anytime soon anyway.
Very good. Well, I'll just wrap up. Thanks everyone for attending. We hope you got a lot out of that. I did forget to mention at the start, the webinar is recorded, so we'll get that and a copy of Bryce's slides sent out tomorrow, so you'll be able to watch that back or revisit the slides, or feel free to pass it on to anyone who you think might get some benefit out of it. We'll also send around the SurveyMonkey. So again, we're trying to sort of, I know the feedback from the first one of these market updates was to sort of do it on a more regular basis. So that's sort of what's prompted this. So we're going to try and keep that quarterly. But again, if you've got anything else that you'd like to hear from, and on that basis as well, we have Simon Lever from Cross Asia Pacific. So next Thursday, Pete, is that right? You disappeared.
Sorry, man, I had to mute. Yeah. Yes, next Thursday at 4:30. So Simon's going to do a importance of workplace health and safety and some workplace health and safety tips as well. So that'll be quite
cut through that. So, and that's on next Thursday. So if you want to come along and listen to that, I'm sure I always pick up a wealth of information from Simon whenever I'm talking to him, and there's always heaps of stuff there that I didn't even know was a rule or a risk. So very important information there. But we'll wrap it up there. Thanks, everyone. Have a good afternoon, good weekend, and good Christmas. Thanks again, Bryce.
Thanks, everyone. Have a good one. See ya.
always good to